Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500 and today is Autodesk Incorporated, ticker ADSK. In the next 5 minutes, I'll discuss both my valuation of this company and what I think about its business quality. So let's dive on in. First thing up is in the software industry. This is somewhat appealing because you tend to get relatively good returns in the software industry. So let's see what they do. They provide 3D design, engineering, and entertainment software and services worldwide. AutoCAD, Civil 3D. That's pretty good. I've heard of that software. That's a good thing. Computer-aided manufacturing, AutoCAD, professional design software, Fusion 360. So everything in here looks like you might have a business where you have high lock-in. That could be very attractive in terms of your business model. So let's look at return on invested capital. First thing I see here is that your returns on capital are not stable at all. They're all over the place. So this lack of stability indicates a relatively lower quality business, despite what I just said before. And then the next thing I see is from 2016 to 2019, you had 4 straight years of losses. 4 years of losses within a 20-year period on its own would be bad, but 4 years of losses in total, in a row, suggests that you could be in a business that has some risk of bankruptcy because you might have sufficient losses during a bad cycle all at once that could drive you into bankruptcy. So that's a very big concern. So despite the fact that you have 2021 returns of 45% return on equity, the fact that these volatility of these returns is so high is that your compound annual growth rate is going to be substantially lower than even your good or best year returns because you have these low returns averaging out. And you can see that when you look at 10-year median returns. Return on assets of 2.8%, equity 7%, return on invested capital 5%. All these returns suggest a low quality business that would not be something I would want to invest in. When we compound that by looking at the valuation factors, a P of 85 is ridiculously expensive. Price to book of 50, ridiculously expensive. Price to sales of 10, EV to sales of 10. All of these are extremely expensive for a business with such poor returns. And the tough part is you look at this and you say gross profit's 88%. This should be a strong business. This should have lock-in. This should have high gross margins like what they're showing, 90% gross margins. That should be able to provide a stable bottom line, stable earnings, stable growth. But you don't see that. So it's maybe being mismanaged. It's really hard to tell based upon the numbers that I'm seeing here. The next thing I want to touch on here is your 10-year CAGR. Now, 10-year revenue growth of 7% is pretty solid. But the fact that you're growing assets faster than your revenue is going to lead to declining returns over time. That's not good. You're also growing your revenue faster than earnings per share. Again, that's because your asset intensity is increasing faster than your revenue. That's going to lead to less returns, negative operating leverage from earnings per share, which doesn't make any sense for a company that's in the software industry to be seeing numbers like this. It's really not what you'd want to see. If you're enjoying this video so far, please hit the like button on this video and hit subscribe. If you ring the bell, you'll get notifications as I upload new videos, so you can join in on all my future videos. Now, the income statement is going to help us maybe sass out what's going on here. So you see relatively strong R&D. What's interesting is you have these huge gross profit numbers, and they're being eaten up completely by SG&A. The R&D is here too, but the SG&A is increasing much faster. And so you have strong gross profit, but very hard and low operating profit. It's really killing your ability to actually get a return here. In addition, your net income, that's where you're fluctuating. You have these big negative net income numbers. Here's a negative 310 for income tax. What happened in 2016? Maybe that's related to the tax relief. That's hard to say. Some of these numbers are just all over the place. Income taxes are really destroying your net income numbers, showing that volatility is really messing everything up. Now, your earnings per share, you can see shares are basically flat over the decade. I need to go see the balance sheet. What are we doing here? So there's relatively low PP&E. That's not the concern. You do see goodwill growing over time, so they're completing acquisitions almost constantly is what it looks like. But your total assets have, more than doubled. Let's see, liabilities. Where's the debt? You've taken on $2.2 billion in long-term debt. You've added operating leases to that. You have some deferred revenue here, which is explaining some of it. we need to see what's going on in the cash flow. This is a hard business to figure out here. Now, first thing I like here is that despite those losses that I saw for 4 years, you have 10 straight years of positive cash flow from operations. Now, 2018 was particularly bad. It only had $1 million of positive cash flow from operations, but you're seeing, the cash being spent in other ways. You have acquisitions, investments being made, PP&E, and so that's kind of playing into that. Now, what I see here is you have very, very large stock-based compensation. This is huge stock-based compensation. And although you have constant buybacks in shares, how much did they buy back in shares? 200 million, 100 million, 200 million, 3.5 million. So you're buying back, what is this, maybe $500 million in shares over the course of the decade, and the share count has gone nowhere. What did I say on the balance sheet? Where's the balance sheet? No, on the income statement. Your share count is started the decade at 226 and it's at 220. Basically no decrease in shares outstanding despite spending billions and billions of dollars on net issuance of common stock. So this company is being run for employees. It's very clear by these numbers that employees basically own all the equity of the company because it's completely offsetting any cash flow from operations, and you're not seeing that drop to bottom line, which is why the company is being valued at such a high number. If I had to guess, they probably use adjusted numbers and they adjust out the stock-based compensation. So on an adjusted basis, this earnings number probably looks amazing, but on a non-adjusted basis, it looks terrible. The price to book is irrelevant because the book value is being manipulated by stock buybacks. So I don't care about the price to book, but I do care about the price to earnings. I do care about the price to sales. This company is extremely overvalued, very low quality because they've been unable to maintain a stability of earnings. They're not earning high returns on capital. I would pass on Autodesk both for its business quality and its valuation. Completely untenable here. And as far as I can tell, it's being managed for employees and not for shareholders. Thank you for listening. If you enjoyed this video, please hit that like button on the video. That helps me to grow the channel. Don't forget to subscribe and ring the bell so you can get notifications as I upload new videos in the future for more great investing content. Thank you for listening, and until next time, stop paying fees, start building wealth.